Think the housing frenzy is still unbeatable? Watch closely. In 2026, nearly a quarter of major metros are expected to see prices fall, and these 10 markets are already buckling under higher carrying costs and growing listings. The dream has hit a wall. We'll reveal the 10 cities where overvaluation meets reality, where insurance spikes, affordability strain, and cooling demand collide. You'll see why buyers are winning negotiations and why sellers are bleeding concessions. This is the pivot from hype to hard math. Stay to the end to see which market signals the wider break. Before we continue, hit subscribe so you never miss the latest updates. Number 1, Cape Coral. Fort Myers. Think Florida's boom is untouchable? Cape Coral is the epicenter of the collapse. The pandemic glow has burned out, and what's left is a crushing cost stack that buyers won't accept and owners can't carry. The dream has hit a wall. For 2 years, easy money and remote moves pushed prices into the stratosphere, but the balance sheet flipped. Insurance premiums spiked, taxes adjusted up, and utilities marched higher. But monthly payments didn't inch up. They detonated. The result is brutal. Demand retreats while sellers cling to fantasy comps. And the listings keep coming. Homes that would have vanished in a weekend now sit as days on market expand. Price cuts are no longer a tactic. They're survival. Buyers walk after seeing the insurance quote. Lenders balk when ratios blow up. Peak pricing is dead on arrival. The reason? Hurricane risk repricing has reset the table. Insurers left or narrowed coverage. Deductibles climbed. Policies exclude more, cost more, and renew higher. Then comes special assessments for roofs, seawalls, and code upgrades. One line item doesn't break you, 10 do. Affordability gets crushed. Forecasts point to Cape Coral leading price declines into 2026 as inventory builds and absorption slows. That's not noise, that's a pipeline of forced realism. Days on market stretching is the tell. It signals buyer control, and once that control sets in, sellers chase the bid down. After storms, rehab isn't cosmetic. It's electrical, roofing, moisture remediation, elevation compliance. Labor is scarce, materials cost more, and the insurance renewal shows up with a number that doubles, or worse. Sellers who can't stomach the next premium unload with distressed cuts. Buyers demand major credits just to underwrite the risk. Overvaluation is the core rot. From 2020 to 2022, valuations broke from local incomes. Wages in the service-heavy economy never supported those purchase prices once rates normalized and premiums exploded. This isn't sentiment, it's math. The payment shock suffocates the move-up buyer and the new entrant alike. And now buyers dictate terms. They want repairs, closing cost concessions, and rate buydowns. They demand inspection fixes and escrow credits because they know inventory is swelling. Without these concessions, deals fall apart at the insurance binder. Leverage has flipped, and it's not flipping back. Cape Coral leads this downturn because the insurance shock makes ownership unsustainable. When carrying costs outpace incomes, price collapses follow. That's the mechanism. That's the reckoning. Sellers who anchored to 2022 are catastrophically underwater on expectations, and the market is repricing them in real time. Think this is an isolated crack? It's a fault line stretching along the Gulf where the same cost, surge, and risk repricing are tearing through once, safe growth stories. The next metro is already showing the same fatigue, the same stack of listings, the same costly math. Number 2, Northport, Sarasota, Bradenton. Luxury branding met hard math, and the math is winning. Northport, Sarasota, Bradenton sold a lifestyle at a premium, and buyers paid it. But premiums don't pay mortgages, they inflate them. The shine has worn off as the carrying costs swallow budgets, and the status purchase becomes a financial chokehold. Retiree capital and remote work wages pushed prices to unsustainable highs. That wave lifted comps far beyond the reach of local paychecks and fixed incomes once rates normalized. The pipeline is now clogged with sellers testing yesterday's numbers and buyers armed with today's risk-adjusted math. The result is a visible reset. Insurance inflation is the accelerant. Policies renew higher. Deductibles jump. Coverage narrows. At the same time, Florida's stricter condo maintenance rules force associations to raise reserves and dues. Inventory swells because owners who can't keep up list, and demand thins as buyers underwrite the full cost stack. That's a demand suffocation. Monthly payments balloon with premiums and HOA hikes even before principal and interest are considered. Cash buyers feel it through assessments and taxes that don't care about loan balances. Financed buyers see ratios blow past lender thresholds. Deals die at the binder and resurrect only with aggressive credits. This is affordability collapsing in real time. Research pins this metro for an 8.9% price drop in 2026, among the steepest projected declines nationwide. Contracts already show the shift. More seller-paid closing costs, more repairs covered, more rate buydowns to disguise the real price cut. When concessions rise, it signals leverage has flipped and sellers are bleeding to get to the finish line. Builders are blinking. Excess spec homes don't move without discounts, appliance packages, and rate buy-downs at the sales office. Base prices look stable on paper, but the back-end incentives carve them down. The showroom smiles, the spreadsheet screams. That's the quiet capitulation. Local wages don't bridge the gap to pandemic-era valuations. Service jobs, healthcare, and public sector pay can't chase premiums, taxes, insurance, and HOA dues rising in tandem. The affordability fracture widens each month, and the bridge back to equilibrium is lower prices, not higher pay. How fast does a forever home market turn into sell fast or drown? Faster than owners expect and slower than buyers hope. Listings linger, price cuts stack, then the next listing undercuts them by another 5 figures. Momentum turns negative, and the floor keeps slipping. The mini payoff is clear. Northport is sliding from exuberance to capitulation. The luxury story still photographs well, but the ledger tells the truth. Ownership here is being repriced to reality, and reality is harsh. The narrative jumps west next, where a different cost stack, less insurance, more structural headwinds, drives the same full-blown disaster and the same brutal reckoning for anyone still anchored to peak-era comps. Number 3. San Francisco, Oakland, Hayward. For years, tech money hid the affordability crisis. Not anymore. The gloss is gone, and the cost burden is exposed in San Francisco, Oakland, Hayward. The dream of limitless demand collided with a payment shock, and the psychology cracked. This is one of the highest cost markets in America. Rates stayed elevated. Remote work thinned the buyer pool. Layoffs rattled confidence. Households that once stretched for prestige addresses now run the numbers and walk away. The result is a brutal reckoning in a city that used to defy gravity. Price per square foot is still punishing, but the tempo is slowed. Days on market stretch. Price cuts normalize. Sellers test aspirational comps and then chase the bid down, week after week. The status premium no longer closes the gap. The trifecta is clear. Affordability strain suffocates new demand. Downtown office vacancy drains life from core neighborhoods. And outmigration siphons buyers to cheaper metros where the same income buys a yard, not a studio. When that 3-part pressure hits at once, pricing power collapses. Research flags a 2026 decline for this metro, with a forecasted 2.5% drop in home price growth. Listing to sale price ratios have slipped from peak-era heat, signaling the end of automatic over-ask outcomes. Even in a so-called seller's market, the trajectory is down. That contradiction is the tell. Look at the core. Condos near the financial district site empty, lights on, but no one home. Resale units fight a losing battle against new stock, dangling incentives, credits at closing, months of HOA dues covered, upgrade packages that quietly slash the effective price. Old comps don't stand a chance against a sales office armed with giveaways. Investors see the spread vanish. Rents soften as urban amenities lag and office foot traffic fades. Ownership costs, taxes, HOAS, maintenance, and today's rates blow past rent parity. The math doesn't pencil, and the buy-to-hold thesis unravels. You don't buy negative cash flow with downside risk unless you're gambling. And it gets worse. Once prestige stops supporting premiums, gravity wins. The halo effect fades, and the market trades on fundamentals, not mythology. The analogy is simple. A luxury brand losing its waiting list. Prices don't glide. They drop until inventory moves. The mini payoff is undeniable. San Francisco's correction proves even marquee markets are not immune. The metro that set national comps is now cutting to clear, and that shift ripples through every segment tied to it. Sellers learned the hard way that liquidity is not guaranteed. The next chapter is obvious. Texas promised affordability and growth, then oversupply met rising rates, and the same harsh arithmetic took control. Number 4, Austin. Austin was the hottest boomtown of the pandemic era. Now it's drowning in supply. The skyline cranes didn't stop, and neither did the subdivision sprawl, but the buyers did. The frenzy flipped to a glut, and the market is choking on inventory. The setup was textbook mania. A massive building pipeline collided with investor buying and rapid appreciation, stretching comps far beyond fundamentals. High-wage migration and cheap money turbocharged bidding, then vanished when rates reset. Builders kept pouring slabs while the demand engine stalled. That mismatch is the fuse. The tension is visible on every MLS feed. Inventory piles up, especially in the outer rings, where commute times and utility bills are higher. Builders slash base prices and quietly buy down rates at the sales office. They don't call it a cut, they call it a program. But the payment tells the truth. Wage growth isn't catching the tab. 2021 to 2022, pricing doesn't clear in a 6+% mortgage world. The result is a financial chokehold on would-be buyers who now compare monthly costs against rent and walk. Overvaluation isn't a debate, it's the gap between what households make and what ownership demands. Research shows price pressure resurfacing as new listings reappear and contracts cancel at the last minute. Deals fall apart when appraisals miss or underwriting balks at debt-to-income ratios. A buyer signs, the math breaks. The listing returns with a motivated tag. That's not noise, that's capitulation. The showroom playbook is a tell. Builders dangle closing credits, cover title fees, and offer temporary and permanent rate buy-downs. On paper, base prices look stable. In reality, the net price is bleeding lower. Incentives mask an effective decline that comps won't show until the next resale cracks. Investors are getting squeezed. Short-term rentals face higher vacancies as travel cools and supply surges. Brewer-Archer models fail when rents flatten and repair costs rise. Carrying costs stack, taxes, HOA, insurance, maintenance, and cash flow turns negative. You can hold the asset, but you can't hold your breath forever. The real shift is arithmetic. More supply, slowing absorption. Rent parity tilting against buying. You don't need a forecast to see the next leg down. You need a calculator. When incentives stop working, the only lever left is price. The mini payoff is blunt. Austin is the canary for overbuilt, overhyped boomtowns now staring at a full-blown disaster. The brand is strong, but the balance sheet is weak. The pipeline is long, the demand is shorter, and sellers no longer control the clock. And now the pressure spreads. Migration patterns are bending, and multifamily deliveries are flooding key corridors. The Rockies offer no shelter when the same math hits. Excess supply, softer rents, and ownership costs that no longer pencil. Number 5, Denver, Aurora, Lakewood. Denver's ascent just hit a wall. Supply is rising while demand shifts. The metro is losing altitude fast. The question isn't if momentum broke, it's how far it falls before sellers capitulate. This is a brutal reckoning disguised as balance. The urban core has lost pull. Buyers push into surrounding counties for lower taxes, newer builds, and cheaper monthly costs. Meanwhile, a surge of multifamily deliveries keeps rent growth contained, which caps what buyers are willing to pay. When the rental ceiling drops, ownership premiums evaporate. Sellers are anchored to peak comps from the frenzy years. Buyers aren't playing along. Inspection repairs are back on the table. Credits at closing are standard. Rate buy-downs are demanded, not offered. Every concession is a tell that leverage flipped and sellers are bleeding to keep deals alive. Normalization or collapse? It depends on how fast excess supply clears. If inventory lingers, price discovery gets ugly. If multifamily vacancy rates stay elevated, rent parity tilts further against buying. The outcome is not sentiment, it's throughput. Clearing slower means cutting deeper. Research calls it plainly. Denver is projected to see a 3.4% decrease in home price growth in 2026, signaling a sharp cooldown from the pandemic surge. That's not a blip, that's negative pressure sharpened by outward migration and a buyer pool that now has options and leverage. You can see it in Class B neighborhoods. Fresh apartments roll out concessions, and suddenly the monthly cost to rent undercuts a mortgage with taxes, HOA, insurance, and maintenance. Listings that once sold in a week now sit, and sellers trim price after price to get under the rent line. That's the tell of a weakening spine. The affordability crunch is mechanical. A 6% plus mortgage rate, elevated insurance, and rising utilities stack into a financial chokehold. Rent parity wins the argument quickly. If you can rent a comparable unit for hundreds less per month, you wait. Waiting starves demand. Starved demand forces price cuts. And when rent softens while inventory rises, pricing power doesn't fade. It vanishes. Think of it like a dam cracking from both sides. Less pressure behind it, more water pushing through. The structure doesn't bend gracefully. It gives way all at once. The mini payoff is blunt. Denver's slide is quiet but relentless, and the leverage has flipped to the buyer. Offers come with contingencies, concessions, and inspection lists that would have killed a deal 2 years ago. Now they close, and they close lower. Head south, where a Sunbelt titan is staring down the same fatigue, deeper inventories, and sellers who are running out of tricks as price cuts become the only language buyers will accept. Number 6, Phoenix, Mesa, Scottsdale. Phoenix thrives on momentum. The momentum is gone. The metro rode a surge of in-migration and speculative capital, stacking fragile comps on top of each other like a wobbly tower. Take away the flow of easy buyers, and the structure stops holding itself up. The result's a price freeze at the top and a brutal reckoning for anyone anchored to peak-era expectations. The setup was simple and dangerous. Rapid relocations, bulk investor buys, and flip-friendly financing pushed valuations ahead of wages and ahead of fundamentals. That jet fuel is spent. Listings reappear, showings thin out, and the bid fades. You feel it in the silence after a launch weekend that used to generate 10 offers and now gets none. Inventory rises while demand hesitates. Investors exit or sit on their hands. Transactions stall at the affordability wall where payments fail the monthly test. Sellers post aspirational numbers and then walk them down with motivated notes and staged relists. When volume slows, price discovery turns cruel. Carrying costs are the chokehold. Insurance renewals ratchet higher. Summer utilities punish larger square footage. HOA fees climb to cover reserves, amenities, and aging systems. Even buyers with solid down payments see the all-in total jump past comfort. Ownership math loses to rent parity, and that stalls absorption. Research calls out a slower 2026 path for Phoenix, with sellers leaning on price cuts to spark traffic. And that's the tell. You don't slash asking prices in a healthy climb. You cut when showings dry up, and feedback is the same. Too expensive for the monthly. The flip machine is misfiring. iBuyer-style models that banked on quick resales now face longer days on market and higher repair bills. Cosmetic refreshes no longer pull top dollar. Buyers demand inspection credits for roofs, HVAC, and slab cracks. The carry drags, the fees compound, and the spread evaporates. Investors in turnkey rentals are feeling compression. Rent growth plateaus while taxes, insurance, and maintenance creep up. Cap rates that once penciled now bleed cash. You can swap tenants, but you can't outrun expenses. That is how portfolios shift from hold to dispose. Without bidding wars, the premium vanishes. No escalation clauses, no appraisal gaps. Just disciplined offers, inspection lists, and lowballed counters. Think of it like a stadium losing the crowd noise. The team on the field hears every mistake, and momentum swings fast. Mini payoff. Phoenix is freezing at the top. Price discipline is back with a vengeance, and sellers chase the real bid, not last spring's fantasy. The comps built on adrenaline are collapsing into sober math, and the new floor sits lower than owners want to admit. Next, we head back to Florida, where coastal glamour runs straight into insurance reality, and premium shocks rewrite what affordable ever meant. Number 7. Deltona, Daytona Beach, Ormond Beach. It looked like an affordable coastal escape. The bill arrived. Deltona Daytona Beach. Ormond Beach sold the dream of salt air and low payments, but the ledger now shows a financial nightmare. The region is paying a hidden risk premium that was ignored when the frenzy was loud. Pandemic inflows lifted prices fast while structural risks stayed underpriced. Buyers chased comps, not risk. They saw sunshine. They didn't see the actuarial tables. That gap is closing, and when risk gets repriced, the equity built on hype evaporates. Insurance spikes are the accelerant. Premiums jump on renewal, coverage narrows, and deductibles rise. Flood risk reassessments push more properties into costlier policies or higher base rates. Aging housing stock adds its own bill. Roofs at the end of life, electrical updates, wind mitigation, flood vents, and elevation issues. Each line item piles onto the monthly and suffocates demand. Ownership math is merciless. Premiums double. The HOA assessments climb to rebuild reserves and meet maintenance requirements. Taxes reset. You run the monthly and see red. Buyers walk. Listings linger. Days on market stretch while price cuts turn from strategy to surrender. When the binder quote kills the debt to income ratio, the deal is dead. Research underscores the direction. According to the Realtor.com 2026 National Housing Forecast, Deltona is projected to see a 3.6% decrease in home price growth in 2026, placing it among the steepest slowdowns in Florida's coastal second-tier metros. The reason is simple. Rising insurance premiums and climate-related risks are making buyers more cautious, cooling demand while inventory expands. On the ground, sellers are throwing money at the problem. Credits at closing to offset first-year premiums, prepaid HOA dues, repair concessions just to satisfy underwriting conditions tied to insurability. The net effect is a lower effective price that comps won't show until the next sale clears even lower. The psychology flipped in one renewal cycle. FOMO turned into risk avoidance. Buyers ask for elevation certificates before they schedule a showing. They price the roof age, the wind mitigation report, and the flood map into the first offer. And if the math fails, they move on. Sentiment doesn't override spreadsheets anymore. The market doesn't negotiate with actuarial tables. Insurance carriers and flood maps set the floor, and families either pay it or step away. Think of it like a toll plaza that keeps raising the fee. You reach a point where traffic stops flowing because the price of entry is punitive. Mini payoff, Deltona Daytona Ormond is pricing in risk the hard way, through steep cuts, heavier concessions, and longer sits. Ownership here now requires cash buffers most buyers don't have. And that sets up the next reveal. A bigger Florida market shows how wide the damage runs. Number 8, Jacksonville. Jacksonville scaled fast. The growth story broke under its own weight. Oversupply is meeting higher carrying costs, and the metro is slipping from momentum to a buyer's market. The dream of endless absorption has hit a wall. Builders chased demand at full speed. Subdivisions sprang up across the Beltway while investors piled into rental stock, betting on permanent in-migration and endless rent gains. That wave is gone. What's left is a pipeline that keeps delivering units into a slower buyer pool and a cooling rental scene. The tension is visible on every listing feed. More homes, fewer bidding wars, and offers that arrive with demands baked in. Buyers want permanent rate buydowns. They ask for closing credits. They expect inspection repairs and price cuts to clear appraisal. Sellers who reject that playbook sit, and then they slash. The cost stack is the chokehold. Insurance premiums step higher, tax assessments reset, and HOA fees climb as associations rebuild reserves. The affordable Florida promise erodes when the all-in monthly payment jumps hundreds of dollars a year over year. You don't sell payments that don't pencil. You discount or you stall. Research frames the next phase. 2026 forecasts show cooling with increased inventory loosening wallets, not prices. Translation: buyers get leverage and choice, while sellers trade speed for concessions. That is the anatomy of a slow grind down. On the ground, the examples stack up. Subdivisions cut base prices on spec homes to move standing inventory before quarter end. Builders roll out appliance packages, closing credits, and buy downs that quietly carve the net. Meanwhile, rent growth stalls against new deliveries, and vacancy pressure forces landlords to hold rates or offer free months. The house of cards leans. The local economy can't keep pace with pandemic-era valuations. Wage growth in logistics, healthcare, retail, and military-adjacent employment doesn't bridge the gap to 2021 to 2022. Comps at today's rates and premiums. Overvaluation is no longer debate. It's the monthly cash drain families refuse to accept. And now absorption slows. When showings thin and contracts slip, price discovery gets brutal. The first cut finds crickets. The second cut triggers low offers. By the third, the neighborhood comp resets downward, and the next seller starts below it. That spiral is how a growth darling turns defensive. Mini payoff. Jacksonville is shifting from trophy growth story to negotiating table. Fast. Buyers set terms. Sellers pay for the privilege of closing. The leverage moved, and it isn't moving back while inventory stacks and costs stay elevated. Away from Florida, a southeastern tech hub is slipping under the same weight of payment shock and a quieter buyer pool, and the next stop shows how fast prestige fades when the monthly doesn't work. Number 9. Raleigh. Raleigh's fundamentals are strong, but the payment shock is stronger. High incomes in tech and biotech helped fuel the rise, yet the monthly math now kills momentum. The dream hits a wall when a mid-sixes mortgage rate turns a starter home into a financial chokehold. The setup is clear. High wage migration lifted prices beyond local affordability bands during 2021 to 2022. Salaries expanded the buyer pool, but they also inflated comps well past what Raleigh's broader workforce can sustain at today's rates. That inflation is now being unwound, line by line, offer by offer. As rates stick near the mid-sixes, buyers step back. They test the monthly and walk. Sellers respond with incentives. Closing credits, rate buydowns, and inspection repairs they would have laughed off 2 years ago. Each concession is proof. Leverage no longer sits with the listing side. Inventory is creeping higher. Not a flood, just enough to end seller dominance. More choice means slower decisions and tougher negotiations. The urgency is gone, which is deadly for premium pricing. When showings thin out, the first tool is a cut and the second is another cut. Research backs the turn. The 2026 outlook shows a 3.7% decrease in price growth year over year, signaling moderation with pockets of outright declines, where building ran ahead of demand. Overbuilt submarkets feel it first, newer subdivisions competing against each other with identical floor plans and a shrinking pool of qualified buyers. Look at the suburbs. Listings sit for weeks with low traffic. Then come the repeats. 5-figure price reduction, then another after the second open house draws crickets. The feedback is the same. Payment too high. Taxes and HOA too heavy. Commute not worth the premium. Price cuts stop being strategy and become surrender. Corporate growth doesn't save the math. Salaries help, but they don't bridge the leap from 2021 to 2022 valuations to today's carrying costs. Taxes recalibrate upward. Insurance and utilities nibble at the edges. The all-in monthly swells, and households refuse to bleed cash for prestige zip codes. The Southeast story here isn't boom. It's recalibration. Think of a thermostat clicking down after a surge. The room doesn't freeze instantly, but the temperature drops until the system stabilizes. Raleigh is in that cooling phase, and it's unrelenting. Mini payoff. Raleigh has hit its affordability ceiling, and the leverage has shifted to the buyer. Offers come cleaner, contingencies stick, and sellers fund the difference to get across the finish line. Price discovery is happening in the open, and it points down. Next, California's Central Valley shows the other side of the West Coast unraveling, where spillover demand has dried up and the new floor is being drawn lower with every stale listing that finally blinks. Number 10. Stockton. Lodi. When Bay Area buyers stop spilling over, Stockton's scaffolding shakes. The entire pricing structure leaned on outside money chasing more house for less. That external support is fading fast, and the frame is buckling under its own weight. Pandemic-era migration inflated values as commuters hunted cheaper space along Interstate 5 and Highway 99. Remote work let high earners keep Bay pay while paying Valley prices, and comps sprinted ahead of local fundamentals. That tailwind is gone, and the air pocket is brutal. Remote work pullback and affordability fatigue have reduced external demand. Companies are tightening hybrid schedules. Commutes look longer, and with higher rates, the payment shock wipes out the perceived discount. The bid from across the Altamont is thin, and sellers can't will it back. Payments versus wages is the breaking point. With rates elevated, taxes adjusted, and insurance higher, the commuter discount isn't enough anymore. Local incomes in logistics, agriculture, healthcare, and retail can't carry 2021 style valuations at 2026 financing costs. The monthly math is unforgiving. Research is blunt. Stockton is forecast to see a 4.1% decrease in home price growth in 2026, the largest projected decline in California and the third largest nationwide. That's not noise. That's leadership in a downturn, driven by a slowing Beta Valley pipeline. On the ground, the corridors tell the story. Listings along the Dublin-Pleasanton-Baird feeders and I-205 cut asking prices to spark traffic. Fixer-uppers near commuter routes sit longer as buyers price and rehab risk. Roof, electrical, HVAC, and demand-heavy credits. Days on market stretch and the next comp prints lower. Investors are exiting. Flips stall as materials and labor stay expensive, while buyers scrutinize every pyramid, every patch, every pest report. Cosmetic turns no longer clear top dollar. Carry drags, holding costs bleed, and the spread evaporates. When the profit window closes, the only lever left is price, and the demand redistribution isn't saving the core. Outward moves into newer fringe subdivisions cool the center, and the city loses momentum. Think of a scaffold losing anchor points. Remove enough, and the structure doesn't sag gracefully. It collapses where the pressure is weakest. Without outside buyers, local fundamentals set the floor, and it's lower. Inventory builds, showings thin, and offers arrive with contingencies, repairs, and rate buy-downs that erase the last 2 years of paper gains. Sellers who refuse reality sit, then cut, then chase. That's it for today. Like the video, subscribe to the channel, and stay tuned for more updates you won't want to miss.